There we go. I think we are now live in session. Welcome everybody to Professional Accountancy Online 2020. Shape the Debate, sponsored by Free Agent, with me, Tony Stevenson, hosting today's live question and answer session. During today's live session, offering 1 hour of CPD, our expert panel will be answering questions from the 3 previous events. There'll be an opportunity to put your questions to the panel live today. Just a bit of housekeeping. So a recording of today's live session will be sent out via email within a couple of days. So please do keep an eye out for this. Excellent. So on with the introductions. So myself, Tony Stevenson. For those of you that don't know me, my name is Tony Stevenson. I'm a practice implementation consultant at Free Agent, where I help accountants to get the most out of Free Agent's award-winning online accounting software. I spent the first 10 years of my career in practice as a corporate tax consultant before moving into the cloud accounting software industry. Since then, I've been using my experience to support both small businesses and accountants through cloud accounting software. I am also, for my sins, a fellow of the Institute of Chartered Accountants for England and Wales. So Free Agent, my employer, so we're a UK-based award-winning online accountancy software designed specifically for small business owners and their accountants and bookkeepers. With over 100,000 active users, Free Agent's powerful end-to-end accounting functionality simplifies the admin associated with your small business clients and gives you the robust features and proactive alerts that your practice needs. For anyone that wants to find out some more information on Free Agent, you can visit our website. Or you can visit the online exhibition at www.profaccountancy.com. That's www.profaccountancy.com. With me today on the expert panel are Mike Ulrich, ACA. So Mike has been involved in presenting courses and seminars to professional accountants for over 20 years. This is the 3rd webinar I've done with Mike now, so I'm getting quite used to his bio. He's a technical consultant on accounting and audit matters to a number of firms, providing answers to real-life issues. He also undertakes compliance reviews, both audit and audit exempt, for a number of firms, and provides advice and guidance as required. Both of these provide him with an insight into these topics, which are of practical interest to practitioners and accountants in commerce. He has his own practice, and he's also a statutory auditor. With his background, it enables him to see both theory and practical aspects, and the presentations reflect this. Alongside me as well is Val Stewart. So for over 20 years, Val has worked with accountancy practices, helping them to develop their businesses and remain compliant. She's the author and co-author of a number of technical guides and work programs and specialises in the not-for-profit sector, lecturing and advising on charities and cooperatives of all sizes. She's actively involved in the charity sector, acting as a trustee, as well as her involvement in the technical aspects of the sector. She enjoys helping firms to develop, advising on training and staffing policies in all aspects of practice management. She also lectures widely on auditing, management skills and assurance services. So welcome to you both, and let's start answering the pre-submitted questions. So I will be answering some of the questions and also providing the questions as they come through, and also the ones that we've had submitted prior in the 3 webinars that we've already gone before. So the first question is for Val, and it is, what if a DBS check discloses someone's past convictions? Over to you, Val.
I think in terms of that one, the issue that you'd have is that you'd have to consider what the conviction was for. And if it was anything that was that had a financial implication, then my expectation would be that you'd need to get more details of that, and you'd certainly need to talk to the professional body about it to ensure that they were happy that that person was actually somebody who could actually act as a business, sort of one of your more senior officials within your practice. I have to say that from personal experience, I have seen one individual where they had some real problems, but because it was something that had happened that when they were a teenager, and they had sort of, I suppose, paid the price and had acted honourably in terms of the way that the issue had been resolved, then it was the ACCA in this particular case turned around and said that yes, they thought it was appropriate for that person to be considered as being a fit and proper individual. So I think the answer to that one is you can't ignore it. You can't just make the decision yourself. I think that you need to look at the circumstances behind it, and then discuss it with the professional body.
Cool, excellent. So the second question that we've got, also for Val, what additional AML training is required if one is authorised by the ACCA to practice?
So if you're authorised by the ACCA, and I presume that what you mean by that is that you're regulated by the ACCA for money laundering purposes. If they are your regulator for money laundering purposes, their expectations at the moment seems to be, and I think there's some sense within this, is that money laundering, because there is still, I think, fewer reports going in from firms of accountants than they might expect. And that some of that is because people don't actually think about money laundering as they're doing everything that they're doing. Then I think the expectation would be that you train people when they first start. You train people when they move into a different position within the organisation that might give them different levels of responsibility, and then that you'd have some form of general update, which could be something that you facilitated yourself internally on an annual basis, just to remind people of what their responsibilities are and highlighting any topical issues.
Cool. Excellent. Thank you very much. So on to question 3, and this one's for Mike. So the question is, do FRS 105 accounts need to show a true and fair view?
Well, the short answer is that under the Companies Act, Section 393, all sets of accounts need to show a true and fair view. But the true and fair view applying to FRS 105 accounts is probably best described as being different to what we might have had historically. Because also under the legislation, in Section 393 itself, subsection 1A, it then states that FRS 105 accounts, if they only include the statutory requirements, can then exclude any additional disclosures required by accounting standards. So effectively what that comes down to is what is often referred to as a deemed true and fair view. So in other words, provided you include the statutory minimum, then that is fine. You're exempted from all other disclosures. So for example, one of the statutory minimums is not a reference to going concern. So if there are any problems arising with regard to going concern, so in the terms of FRS 102, you've got material uncertainties indicating significant doubt, then that would normally be disclosed under FRS 102, but there's no requirement to disclose under FRS 105 because it's not within the statutory requirements, and you get an exemption from all other disclosures within accounting standards. So from that, as I said, comes the term a deemed true and fair view, which means you broadly end up with a profit and loss account, a balance sheet, statutory information such as registered office, etc., and so on, and advances to directors, contingencies, etc. In other words, it's pretty limited.
Excellent. Excellent. Thanks ever so much, Mike. So we have a question from the audience. So I'll put this either through to both of you, and one of you can pick it up if we can answer this now, and if not, then we'll take it offline and get back to the person. So with regard to rent holidays during the pandemic, if the rent payments are deferred and not forgiven, how should this be accounted for? Any takers, panel?
Yeah, I'll take that because I think I picked up rent holidays as part of the COVID aspect.
Yes, Mike.
I suppose when this first arose, so that would have been around about sort of March, April, May of this year, I think within the UK there were definitely what were called two schools of thought. One was that you effectively took the rent holiday as and when it occurred. So if you end up with a few months where there was going to be no rent, then there was no rent charge within profit and loss. And the alternative view was to work out the value of the rent holiday and then try to spread it on the same basis as you would something like a lease incentive. However, in that respect, it'd be important to bear in mind that unless there was a complete renegotiation of the lease, it would not fall within a lease incentive. The position has now been clarified by the FRC as they've now issued an amendment to FRS 102, which basically states that you take the rent holiday as and when it occurs. So any thoughts about spreading that forward over the period of the lease would not be in accordance with FRS 102. I have to say that also follows exactly the same change that was made from an international standards perspective as well. So there effectively is joined up thinking in respect of that. I don't know if Val wants to add any other comments to it.
No, that's fine.
Excellent. Thanks ever so much, Mike. Thanks ever so much. So on to the next question, which is also for Mike. So the Brexit changes are for financial years commencing on or after the 1st of January 2021. Is it possible to extend the provisions by changing the date of the financial statements and or the accounting reference date?
Okay, so I think we need to be very clear here that under the Act, you've got accounting reference periods and you've got financial years. So your accounting reference period is determined by your accounting reference date. That's the date that all companies are filed with Companies House. But your financial year works in a slightly different way. So one of the questions that initially arose with regard to this, was it in respect of accounting reference periods commencing on or after the 1st of January, or was it financial years commencing on or after the 1st of January? Now, in an open letter issued by the FRC, they've made it quite clear that it is for financial years commencing on or after the 1st of January 2021. So sometimes there's a misunderstanding where accountants believe that accounts have to be made up to the accounting reference date. And this is not correct. You've always been able to make up your accounts to within plus or minus 7 days of your accounting reference date. Primarily, historically, this was to allow in certain sectors where they like to do 52 and 53 week accounting. So trying to come up with a precise date for your accounts would have been referred to as being inconvenient. So if I can make up my accounts to within plus or minus 7 days of my accounting reference date, and my reference date is the 31st of December, then it follows that if I make up the accounts to, let's say, the 30th of December, which, by the way, would have to be to the 30th of December, in other words, thinking about your cutoff, etc., and so on, then my next financial year would start on the 31st of December, 2019, which is 1 day short of the 1st of January. So if you've got a 31st December year end, then as far as I can see, you can make a slight change, which would allow you to extend the requirements perhaps, but it's only going to be for 1 year. It's not going to be any more than that because that's the maximum you're going to get. But it might give you 1 year more to think about what happens next. And then what happens next is it's not going to go back to what it was before. I don't think that's very likely at all. And if you go down that route, you don't have to change your accounting reference date. Now, I have heard from some accountants who have got quite what I refer to as lateral thinking with regard to this, and are even thinking about shortening accounting periods, which would normally finish on the 31st of March 2021, bringing the accounting reference date back to the 31st December, and then doing exactly the same thing. Well, that's fine, but please remember, you've got to be happy with your accounting reference date because there are limitations in terms of extending your accounting reference date at some point in the future. So I think for 31st December, which is the second most popular year end in the United Kingdom, it is a possibility, but it would have to be, you have to think very carefully about others. But if you think about it, you know, for many instances, as I mentioned in the presentation, is to change it to section 479A, which are going to be potentially are going to bear a cost, you know, because some entities will lose audit exemption, which means they'll have to go through the audit process. And that's not going to be, you know, a bill for a few £100. That's going to run into several thousand. So that would be my comment.
Excellent. Thanks ever so much, Mike. Much appreciated. Very detailed. Thank you for that. So the next question, which is one for Val. Is it mandatory to use third-party software to carry out ongoing client due diligence? Many companies selling these types of software are advising that it is mandatory.
The easy answer to that one is to say no, it's not mandatory for you to use them. A lot of firms would say that it is probably one of the most effective ways for them to do the due diligence, particularly in a circumstance where they've got an enhanced risk. So if you're dealing with a low risk client, somebody that sort of like you've met face to face, is not in a high risk business sector, is in an established business that is known to you, then just getting a copy of a passport and a utility bill is still going to be perfectly acceptable. But if you're dealing with one that's an enhanced risk, then it might be that making a choice to go to one of the software houses is actually the most effective way for you to be able to demonstrate that you've checked that they're not PEPs, that they aren't on a sanctions list, all of those sorts of things. So it can be a more cost-effective way for you to do it. The thing that is mandatory for you to do, though, is that if you choose to use one of the third-party software houses, you need to establish how it is that they collect the data that they're using in order to give you a result. So, sort of you need to be happy that they're updating their information frequently enough for you to be able to place reliance upon what it is that they're doing. So simple answer is no, it's not mandatory. You just have to consider what's most appropriate for you. And on another side, in terms of where it's somebody that's new to you, sometimes it can be a little bit faffy if you want to get hold of a copy of their passport and their utility bill. If you can get a reasonable deal with one of the software providers, then sometimes when you actually look at the cost of that in comparison to the cost it's taken you to actually collect the data, to copy it, to write all of the information on, then it can be a more cost-effective way for you to do the client due diligence. But that's your choice.
Excellent. Thank you very much. So the next couple of questions are for myself. So we may have some free agent fans or some free agent interested parties in the audience. Actually, hold on a second. I think we've just had another question through before I ask those ones. We'll ask this one. So again, open to the floor. For the business rate gain, do you recognise in the account when it's received or March 20 when it's receivable? I feel like we may need a little more information than that. Does anyone want to field that at all?
Sorry.
You've gone onto mute, Mike.
Sorry about that. I'm not too sure whether this is a reference to the fact that some businesses will not have any business rates for the year.
I think that probably is it. Yes.
Or whether it's associated with the grants that were paid out by local authorities, which was also associated with the amount of business rates you paid as well. So, or it could be something else. It's not necessarily that clear. So perhaps I'll deal with it on the basis of the business rates question first of all.
Yeah.
If there are no business rates, then there are no business rates. There's no aspect here that it's by necessary falls within the definition of a grant under FRS 102. There just aren't any business rates. You just haven't got the expense. So effectively, you would take that into the accounts as and when it effectively arises, because you haven't got anything to expend. There's nothing to go into profit and loss. If you're talking about the grant that was also associated with business rates as well, and that was the one that was paid sort of by some local authorities before the 31st of March 2020 and by others after the 31st of March 2020, then there has been a bit of a debate with regard to that. Now, I also know that that's one of the questions that have been submitted. So I don't know, Tony, whether you want to take that one now or defer that to when it comes up in the list.
Should we take it now? And then, if we want to take it now, would you like the... Just looking for it. Hold on a second.
It's number 10.
Number 10. Cool.
Number 10 on the questions.
Would you like that as well, Mike, now? For me to...
Yeah, I might as well cover it since it's been raised as a topic rather than sort of put it to one side. It makes a lot of sense to sort of cover it under one heading.
Yeah.
Yes, there has been a certain amount of debate with regard to the recognition of this grant, and also that debate included if you're applying FRS 102, would it make any difference whether you're using the performance model or the accruals model? As far as these grants were concerned, they were actually eligible before the 31st of March 2020. The fact that some local authorities paid out before and some paid after, then in my view, the point at which it could be recognised, putting aside either of the models at this particular point in time, would have been before the 31st of March. So if you're applying the performance model, there are no other performance conditions, so you would apply it automatically. If you're applying the accruals model, there is a provision that says you defer the grant to meet whatever expenditure it's designed to meet. However, there's also a caveat that says if the grant is for general financial support by the government, which includes the local authority, then it's recognised effectively when receivable, when you've basically satisfied the two conditions. So the impression or the information given by both the ICAW and the ACCA is it doesn't make any difference which model you apply. The point at which it will be recognised will be exactly the same, which in my view, and I agree that this is open to a certain amount of debate, and Val might have a counter view here, because like all things in accounting, very rarely are they purely black and white. They're normally what I refer to as various shades of grey. In my view, you'd have to recognise it in the accounts up to the 31st of March 2020.
Yeah,
that's my view.
I agree with you, and I think I've spoken to a few tax people as well, and their view is that that's the revenues view. And so in some respects, their expectation then is that even if you didn't receive the money until April, then the expectation would be that it would go into, if you're a March year end, it would go into your March accounts and would be taxable within the March accounts, which may well mean that it's actually taxable in a period where you've made higher profits than you will in subsequent years. And although it's said in a fairly tongue-in-cheek way, the only real way that you can get around, not if you've got a March year end, not including it within a period before the impact of COVID has actually hit the business, would be to change your year end. So either to bring it back to to shorten it so that you've got a February period, or extend it so that you're taking it beyond the first lockdown. If you'd agree with that, Mike.
Yes, I'd agree with that. But also, if you wanted to shorten your accounting period now, it may be what's referred to as a bit late. But again, it's uncertain because of accounting filing requirements and extensions by Companies House as to whether you could do that now or not.
Mm-hmm.
We've had another question which I think sort of follows on quite sort of neatly from this, but so if you received a grant due to COVID-19, not having to rent out a cottage, is this grant taxable?
Yes.
Simple. That was a simple one. Yeah. It's just replacement income, I guess, isn't it? So yeah. Cool. Okay, excellent. That was a good flurry of questions on that subject, so thanks ever so much for that, and thanks panel. So we have a couple of questions now, which are, for me, as I said, there's a couple of, I think, maybe free agent curious or free agent fans in the audience. So the first question is around free agent. So our free agent owned by NatWest? So yes they are. So we've been owned by NatWest for around 2.5 years now. So May, June 2018 was the transaction date when we became part of the NatWest group. So we are a wholly owned subsidiary of the NatWest group. We were actually the first acquisition since the 2008 credit crisis. We do remain an independent business. When you go into the free agent offices, it's very much free agent, but we enjoy the benefits of being part of the NatWest group, and that really gives free agent a really good foothold in the market for a number of different reasons. I guess the main upside for accountants is that if you have a NatWest or NatWest group business banking relationship, then you can have free agent for free, which is great. Full blown version of free agent, and it's free forever as well. You take it while it's free. And then the next question, which sort of follows on from that in a bit more technical detail, with regard to Brexit, will free agent be ready for the changes that will come in? So I guess it's as Mike said, these things are rarely black and white. Brexit's going to be a changing landscape, but rest assured that we'll do everything to make sure that as quickly as possible, everything can be adjusted in the software and made sure that you're able to continue to operate and make your filings where possible. So as soon as we get the information, as soon as it comes through, we have had the initial bits and pieces which we're working on already. But as soon as it's all kind of finalised and everything, then yes, we'll be endeavouring to make sure that you can continue to operate using Free Agent in the changing landscape. Cool. So on to our next question, which is for Val. So AML, our practice is now specialising mostly with probate services. We do the usual checks before taking on the appointment from the executors of a will. The appointments are always, quote unquote, one-off. So is that sufficient to do checks once at the beginning? I.e., can you confirm there is no need for further monitoring on those cases?
My experience in terms of probate is that quite often they extend over quite a significant period of time. So although it's only a one-off assignment, there might be, sort of ongoing changes. And in particular, you might have changes in some of the executors. There might even be changes in beneficiaries, depending on what's happened. So my view would be that, sort of obviously, if it's done quickly, then yes, it's a one-off exercise. But I think there's almost an unwritten rule that would say that if the engagement extended over a period that exceeded the 12 months, that maybe you should just do a formal review to make sure that you're happy that nothing has changed. But also that you'd need to remember that if anything did change around the will, around the beneficiaries, around the trustees, the executors, then you'd need to actually make sure that you consider the impact of that on your AML assessment, and you'd have to update it. I hope that makes sense.
Cool. I'm sure it does. Thanks ever so much. And then the next question is also for Val. So what is the best layout to use for small charity accounts? Which one should we adopt?
Okay, so I think the issue there would be to say to you that it depends on, this is really twee, but it depends on the nature of the charity and the registration of the charity. So if it's not a company charity, for example, if their income is below 250,000, they can prepare accounts on a receipts and payments basis. And if they do that, they don't have to follow the sort formats. If they're doing if they're choosing to do an accruals basis, or they have to do an accruals basis, then obviously they have to follow the sort formats. And then the requirements in terms of how those are presented and what's within the accounts is determined by the size of the charity. Remembering that if they have income above £500,000 for reporting purposes, that makes them a non-small charity, and so they have to include all of the information. Now, some of this might change because there's a lot of people who believe that it's too onerous. The requirements are too onerous for very small charities. But then I also think that sort of it takes a long time for those wheels to turn. What I would direct you towards is that if you go to the Charity Sort's website, they do actually have some pretty decent pro forma sets of accounts. And actually, for a very simple small charity, they have a couple of Excel spreadsheets that you can use to to put them together.
Excellent. Just looping back round, so we had another question around the legal requirement for a practicing accountancy firm to use AML software. So I think perhaps we just had a late joiner. So I think just in order to recap on that, not mandatory but advisable in certain circumstances. Is that correct, Val?
Yes.
Excellent. Thanks. If that wasn't your question, then please do fire in a more detailed one. That'd be most welcome. Cool. So we've dealt with the next question already. So another one for Mike. Can you clarify the application of the group requirements for intermediate parents as regards accounting and auditing?
Well, I will try to without using any diagrams, etc. And probably the best way to do this is to refer to an issue that actually arose last week with one of the firms that I work with. They just picked up a new client. which was an intermediate parent in the UK. Now, the nature of that intermediate parent was it was trading in its own right, and it had 6 UK subsidiaries underneath it. However, it was part of a much larger group structure that went through various levels and eventually ended up with a parent in the US. Now, within this particular group, there were probably around about 53 entities spread throughout the entire globe. So the question that arose was that the group had always, the UK entity had always claimed it was a small group, didn't apply any audit or anything else of that nature. And there was a concern by the firm that perhaps this may not be correct. So to try and put that into a clarification, so when I'm looking at this from the point of view of accounting, and that is, does the UK parent head a small group, then you would just apply the criteria to that particular subgroup. So that would be turnover, 10.2 net, 12.2 gross, balance sheet total, 5.1, 6.1, etc., and so on, in exactly the same way as you would satisfy 2 out of 3. If that subgroup satisfies those particular requirements, then for accounting purposes, you've got a small group, and for accounting purposes, the parent would head a small group, which therefore makes it a small parent. Therefore, in the terms of FRS 102, they could be using Section 1A for accounting purposes, etc., and so on. However, for auditing, the way the legislation is drafted, it considers it as a group entity, and that is not as part of its own subgroup, but as part of the much larger group. So that would be the entire group, starting with the top in the US, going through the entire global population. So the question that was then getting raised was, is this company part of a small group for auditing purposes? And the real problem was, from the accountant, they really couldn't get all the numbers with regard to turnovers and balance sheet totals from the rest of the 53 entities based around the world. Well, I just applied logic. You know, if you apply logic to 53 entities, are you likely to be below the figures? And the answer to that was probably not. So what you therefore have is a small group for accounting purposes, but you did not have a small group for auditing purposes. It was not a member of a small group, and therefore would not be entitled to audit exemption under Section 477. One thing, of course, that had to be reviewed at that point was, could an intermediate parent within that much larger group give a guarantee under Section 479A for audit exemption? But when we traced the line up from the UK, all we seemed to hit was entities in the island the last 10 years was actually incorrect. Bit of a shock then for the new client at that particular point in time. I never got involved after that, so I didn't know what the eventual outcome of that was. But it becomes an interesting one. Change your accountant and end up with an audit bill. But there you go.
Dropped the mic and walked out, and then never to return. Thanks, guys. Just bear with me just a second. I think. Oh no, it's disappeared. I think we're all right. Sorry, I just had a message from the auditors. Yeah, okay. I think that we need to move to a new room. So just bear with us a second. Okay. So I think we just had a bit of a technical malfunction there, folks. So hopefully everyone's is back online, and we've moved to a new room, and we can continue the questions as we were previously. If you'd submitted a question in the last 5 minutes or so, my suggestion would be that you resubmit it, because we've lost our question list in moving to a new e-room. So if you have, then just fire away again. So the next question on our list is actually for myself. So obviously COVID and Brexit are dominating the headlines of 2020, which we can completely understand. But I think probably the third big issue, albeit probably in third place right now, is the impending MPD for self-assessment, which got confirmed a little while ago as kicking in for March 2023. So the question for myself is, when does MTD for self-assessment kick in, and how many businesses do we expect it to affect? So for those of you that aren't familiar with making tax digital, it's the government's initiative to make us the most advanced digital tax economy in the world, certainly in the G7. What does that mean? It in a nutshell means that businesses that previously haven't had to will now have to file their accounting and tax affairs through a different medium, and a digital medium. So the last round for this was MTD for VAT, which, in all honesty, whilst it did affect several 100,000 businesses, a good chunk of those were already filing through software and already filing quarterly anyway. So the next round is for MTD for self-assessment. So that's going to be all businesses. There are some exemptions, but generally speaking, you can say all businesses that have a turnover between 10,000 and 85,000. HMRC expect it to impact in total 4.7 million businesses, of the somewhere in the region of up towards about 6 million we have in the UK, somewhere up towards that. 1.3 million of those are going to be landlords, and 3.4 million of them will be sole traders, limited companies underneath the VAT threshold, all this kind of stuff. So the answer, I guess, is, will free agent be ready for it? Yes, we have no choice but to be ready for it. We're considering it now. As I said, it doesn't come into March 2023 for self-assessment, but it's going to be an enormous change in the marketplace, particularly for the small businesses that are used to being able to take their bag and box of receipts into their accountant on the 30th of January and say, can you go and fix my tax return for me? They're going to have to file on a quarterly basis, and they're going to have to do it through some digital software. So yeah, big changes coming, and it's going to be interesting to see how that plays out. So the next question is another one for Val. So when we take on a new client, do we actually have to meet them face to face to onboard them, or can we do this remotely, providing we take the usual copy documents and checks?
I think if you don't meet them face to face, then what that does is that moves them up into a higher risk category. There's a lot of debate at the moment in terms of whether us having this sort of meeting, for example, whether that's face-to-face, if you're having a Zoom meeting or a Skype meeting or whichever other service that you can do, so that's not quite face-to-face, but it's almost there. Maybe rolling back to what you said before, if you have somebody that you haven't met face-to-face, because that there is that issue that probably they are moving into a higher risk category because you haven't seen them face-to-face, that might be when you might want to use the electronic verification, because it's just the easiest way for you to do it. And of course, I suppose it's also the easiest way that, if you meet somebody face to face nowadays, most people have got photo driving licenses. Most people, if I went around and asked all of you and said to you, if you've got a photo driving license, how many of you have actually got that in your handbag, or if you're a woman, or in your wallet or your back pocket, sort of. So if you went into somewhere and they said to you, can we have a copy of it, you'd have that ID with you. So I think that in those circumstances, when somebody's face to face with you, it's really easy for you to get a lot of the information that you need, even if you haven't asked them to pre-prepare for it. But if you haven't met them, even if you've done that electronically, and now they're having to provide you with copies of the documentation, you have to see the originals. So would they prefer to actually have you do a credit search, sort of an ID search on them, an AML search on them? Would they prefer you to do that? Or, would they prefer to actually send the original of their driving license so that you can then take a copy of it and say it's original, or take it into somewhere and potentially pay some extra money in order for them to be able to get that countersigned? So sometimes it's easier then to go down the electronic searches. And I just want to add one thing in terms of there.
Of course.
Is that some people worry in terms of the electronic searches that can impact on their credit rating. But because it's just an ID search in terms of what it is that you do, it is silent. If you go in yourself and you did you did your own search on yourself, then it will tell you that somebody has actually done a search on you. So you'll actually have that information. But if you were then going out and getting finance from somebody else, then it wouldn't say that you'd had a search done by a firm of accountants or whatever else, because that's not relevant in terms of your credit scores.
Cool. Excellent. Thanks, Val. So the next question is for Mike. So the question is, we have a client that is a subsidiary of an Indian parent. It satisfies the criteria to be a small company. It has always taken advantage of audit exemption. Is this correct?
Well, I suppose this is a bit like sort of the black and white and grey, really, isn't it? It's going to depend on the size of the overall group, as I mentioned earlier. So when you're looking at this now, you've effectively got two companies in the group. You've got the parent in India and you've got the subsidiary in the United Kingdom. So if you add the parent in India together with the subsidiary in the United Kingdom, would it satisfy the requirements to be a small group? Under the Companies Act, if the answer to that is yes, then it's a member of a small group entitled audit exemption under section 477. If you add the two together, and in my experience, what normally happens at this point is you go way above the criteria of 2 out of 3, then the UK subsidiary is not a member of a small group. It might be a small company, but it's not a member of a small group, and therefore would not be entitled to audit exemption under section 477. India is not part of the EA, so you can't get section 479A either. So effectively, there should be an audit taking place.
Cool. We have another question. I think this possibly was, well, we definitely talked about it earlier, so I think possibly this was a late joiner, but for you, Mike, so if you've received a local authority grant received after the 31st of March, should it be accounted for in the accounts for the year ended 31st of March 2020?
That's going to depend on the nature of the grant and exactly what it is, because there's been lots of grants being made by local authorities, and sometimes I have heard that some of the later ones now have a direct reference to which expenditure is supposed to be meeting. So, for example, as we've gone through, or various areas have gone through various lockdowns, some businesses have received grants to match expenditure that would have occurred over the lockdown period. Now, that makes it precise to that particular period, which therefore would have an impact in terms of accounting for this under the accruals model under FRS 102. If this is a reference to the grants that were being paid out around about March, in other words, those that the government indicated were basically eligible as of, I think the date was the 11th of March or something similar to that, if it was eligible from that particular point in time, but the local authority just didn't get them paid out by the 31st of March, then in my view, and I do draw attention to black, white and grey here once again, then in my view, I think that did satisfy the conditions within FRS 102 to be recognised at the 31st of March. You know, you've satisfied you are reasonably assured that, one, the grant's going to be received, and secondly, you're eligible for it by the 31st of March. Val might also have a view on this because, as I said, it seems to be a grey area from an accounting perspective.
I agree with what Mike's saying. What I would add to that is that from personal experience, that the grants that they're doing at the moment from the local authorities are very much tied in to the restrictions that are paid, that are in place. And so to compensate and make it very clear that they're to compensate businesses that have needed to shut, for example. So we run, as well as having the accountancy practice, we've got a pet shop with a tea room attached to it. So we got the normal grant, the rates related grant at the beginning, and the pet shop, it didn't impact on the pet shop at all because the pet shop was open. But now in this last bit, because we're in a tier 3 area, and so within the national lockdown, and then now we've had to keep the tea room shut, and the local authority then are paying a small grant just for the period that you're shut, and that's done retrospectively every 2 weeks, which I'm sure is the same with most local authorities. So that would be easier to account for, I think.
Hopefully that clears that one up. So on to the next question. This is for you again, Val. So I'm preparing a set of charity accounts. Can I combine the restricted and unrestricted funds in the comparatives on the sofa, as it is hard to fit it all on one page?
No. So you might want to look at whether you put it landscape or portrait, or you see some people that what they do is they have the comparatives on a separate page. However it is that you do it, the comparatives have to actually have that full analysis as well. So you can't leave it out.
Cool, excellent. Thank you for that. So back to Mike again. What are the pluses and minuses in using FRS 105 as opposed to FRS 102?
Well, that's just, how long have we got left, Tony?
We've got about 9 minutes, Mike.
Because that could almost be a 1 hour presentation in its own right.
If you had to pick your top three.
Right. Okay. I should just make the following comments with regard to this. I see FRS 105 accounts as being the Marmite of the accounting profession. To put it broadly, some people love them, some people absolutely hate them. And I do meet firms of accountants who have already made the policy decision they will not get involved with FRS 105. Now, I suspect one of the reasons for that is I've also described FRS 105 accounts as a set of accounts which are absolutely useless to everybody. I don't mean useless to a third party. I mean useless to everybody. Unless you add some additional information into them, frankly speaking, they're not what a lot of accountants would see as being a quality product to give to a client. Now, I don't want to draw any conclusions from this, but personally, I love FRS 105 and I use it for all the clients that I can, but not because I'm producing a document that's completely useless to everybody. I just add additional information outside of the statutory accounts, which provides them with the information that they need, but reduces the disclosure within the public domain. You know, when a member of the public is looking at a balance sheet and what I refer to as very few, if any, notes, you know, what you can conclude with regard to this is limited. Bearing in mind the balance sheet will just tell you you've got current assets and won't give you any analysis with regard to what those current assets are. But I think in that respect, therefore, one of the potential minuses is that if you are aware that the financial statements will be used by a third party and they do use Companies House to look at them, then please bear in mind, if you're looking for a line of credit, and then someone can't see exactly who you are, you might find it very difficult to get a line of credit. So I think it depends on the circumstances of the client and on, I suppose, the client's view. It's not there are pluses and minuses. You know, to a certain extent, you could argue that if you use FRS 105, you don't have to worry about fair values because you can't use fair values. But on the other hand, if you're using historical cost, you may well find that some of your assets, therefore, some people might see it as being understated, particularly if you've got things like investment properties, etc. So if you've got loans with regard to those investment properties, you know, it can upset some of the figures that are being shown within the balance sheet. So I don't think it'd be considered as a strict list of pluses or minuses. I think you have to look at the pros and cons for each individual business, and the directors have to make a decision based on that.
So, yeah, I agree with Mike entirely, and I'm a big fan of them too, just purely for that what Mike said in terms of it gives you more control over what's available in the public domain. But what I would say with a lot of firms of accountants that I come across, as Mike said, they make a decision because they don't like them. So they say, we do FRS 102. And the key thing that everybody has to take away from this is it's not your choice, it's your client's. So you expose yourself to a great risk if what you do is you choose to use one or the other without actually discussing the pros and cons with the client and letting the client decide what's most appropriate for them, which will usually be what you tell them you think they should do. But
of course, right. Of course. Thanks, folks. So I think Mike's already there, got himself penned in for the first webinar of the next series there. A full hour on the topic. Just a reminder to our audience that we have probably got about 5 minutes left of questions. So there's a note up on the chat, but this is your last opportunity to submit any questions that you would like to cover, as we still have a couple left to get through. before the session runs. So if you do want to have any answered by our experts today, then please do put those through now. So next question is for Val. My company is making losses, but we are confident it will become profitable. Can we recognise this in the accounts?
Okay, I think that's referral to deferred tax. So can you actually recognise the benefit of the deferred tax of the tax losses and the financial benefit of those? And the answer to that in terms of FRS 102 would be you'd only recognise them when there is a degree of certainty in terms of when you'd expect to become profitable. So if the client has got good cash flow forecasts and profit forecasts, which would suggest that they're going to turn into profitability and going to utilise those losses within the next year to 18 months, so the foreseeable future, then yes, you could recognise them or recognise it to that extent. But if it's just a wish, you know, sort of that we're really confident that at some point we're going to make a profit, then no, you can't. You could disclose it, but you can't recognise it.
Cool, excellent. So we've got a couple of questions left to cover. Next one's for you, Mike. So if we are aware a client has incorrectly calculated the CJRS grant, should there be disclosure of a contingent liability, or should a provision be included?
Well, that's potentially a fairly tricky question, because actually there's definitely going to be two avenues here. The first is, if the client has incorrectly calculated the CJRS, I think your first consideration before you even worry about a contingent liability or a provision will be, have they made a false representation in order to be able to obtain the grant, in which case then that constitutes fraud, and therefore you've probably got more about suspicious activity reports, thoughts at this particular point in time, rather than what will be appearing in the financial statements. If it has been incorrectly calculated, then putting the AML to one side at this point, Val might have particular comments with regard to that, because she's more of an expert on the AML side than I am. But from the point of view of, have you got a contingent liability, or do you need to make a provision? Well, I suppose you just go through the process of FRS 102. Do you have an obligation to repay that at the balance sheet date? The answer will be yes. I know the response to that will be only if HMRC find out about it, but we're not going to go into those particular depths at this particular point in time. But I would think the answer is you should probably be thinking about more of a provision rather than a contingent liability, because the only reason it'd be a contingent liability is it would only become probable if HMRC find out about it. So my view is you're probably going to be looking more at a provision than you would anything else. But I suspect you may even be thinking about the fact that perhaps we should have a creditor rather than a provision, representing the fact that this should be repaid. Theoretically, if mistakes have been made, you know, employers have had plenty of opportunities as they've been filing subsequent claims to make any changes as necessary. I suspect your money laundering will be the bigger issue here rather than the accounting.
Yeah, I agree with that. I do agree with that. So
excellent. This will be one of the last, if not the last question, depending on how long the answer is, and it's for you, Val. So I am preparing a set of accounts for December 2019 year end. Now, surely, as I know the company is still operating, I can treat it as a going concern.
That's actually quite an easy one. So the issue in terms of that is that when you're considering whether a business is a going concern, you have to look at their ability to continue, not from the date that you're preparing the accounts up to, but from the date that the accounts are being approved. So even if you're so in some respects, the issue that you've got in terms of this is that if you're doing a set of accounts for December 2019 and you're doing it now, your consideration for going concern has to be what's going to happen within the next 12 months. So you're looking at 2 years from the balance sheet date rather than just a year from the balance sheet date.
Cool. I think we may have actually time for one more. Yeah, we have. We've got time for one more, and it's going to be you again, Val. So when a charity has income over £500,000, what additional issues need to be considered?
Yeah. So when we had one of the earlier questions, I actually referred to the fact that within the charities SORP, whereas in order for a charity to be required to have an audit, they have to have income of over £1 million. In order for them to fall into what's considered to be a larger charity for accounting purposes and for disclosure purposes, then that is reduced to £500,000. And it's something that people do miss, and the Charities Commission are fairly hot at the moment in terms of actually working with the professional bodies to complain about charities and their advisors if they've had an independent examination where there are issues with the financial statements that are being prepared. The biggest issue that people have, or there's two issues really, two areas where this has a big impact. The first one is within the trustees report, where there's a lot more information that's required in a trustees report for a charity that's considered as a larger charity. So you need to make sure that you look at that and you discuss that with the client to ensure that all of the issues around risk, reserves, policies and so on have actually been fully included within the trustees report. And the second one is the fact that if you've got income now of over 500,000, then the charity will have to do a cash flow statement. So that is significantly lower than the level at which you'd require one within a company. And very often, I think that's one of the biggest sources of complaint in terms of the Charity Commission for those smaller, but not small from the charity's SORP perspective accounts.
Cool. Excellent. Well, thanks ever so much, Val. Thanks for that. So unfortunately, that is all we have time for today. Thank you for attending the Professional Accountancy Online Live, sponsored by Free Agent. For those of you that have joined us today, and for those of you that have joined us for the 3 previous sessions, have all been extremely informative, and the feedback's been excellent. Don't forget to join Professional Accountancy's online community or on LinkedIn to continue the debate after the live session and to be included in exclusive offers for next year. As I mentioned at the beginning, a recording of today's live Q&A will be sent out via email within a couple of days. Feedback forms for the event will also be sent out in the next few days. By completing this, you will receive your CPD certificate. Please don't forget to visit the online exhibition at www.profaccountancy.com. By visiting the exhibition, you can access a free 1-hour CPD webinar from the 2020 Distance Learning back catalogue. You can also visit our exhibitor profile for more information on the Free Agent. Details of events in 2021 can also be found on the website, of which you can book now. So that's it for Professional Accountancy Online Live 2020, sponsored by Free Agent. Thank you again for attending, and we hope to see you in 2021. Enjoy the holiday season and have a great day, everyone. Thank you very much.
Thank you.
Cheers, Val. Cheers, Mike.
Cheers.
Thanks, Val.
Take care.
See you soon.